Welcome back to Simplify India, your ultimate learning partner. Today we are going to learn about the capital gains. First we are going to learn the meaning of capital gains. A capital gains is a profit realized on the sale of capital assets. It means whenever we sell any of the capital asset, the profit or earnings we make is known as capital gains. These capital assets include shares, house property, or any of the precious metals like jewelry, and it also includes the intangible assets like patents, trademark, etc. Since the capital gain is a profit realized from the sale of the capital asset, so it does not include any other kind of earnings like salary or the profit from the business activities. To find out the capital gains from the transaction, we need to subtract the selling price from the purchase value of the capital asset. Let us find this with the most common example of buying a property. Suppose if we have purchased a land or a building for the amount of rupees 10 lakh. After a few years or after a certain period of time, the value of the property gets appreciated, which results in the increase in the value of the asset. And now you have decided to sell the same property which you had purchased for rupees 10 lakh, as the value of the property is much increased and now you want to enjoy the benefit or the gains arising out of it. And you got a buyer who is willing to buy for rupees 15 lakh for the same property which you had purchased. This is where the capital gain appears. Let us find the capital gain for same example with the help of the formula. Capital gains is equal to selling price minus purchase price, that is rupees 15 lakh minus 10 lakh, which fetches rupees 5 lakh, where it is the gain arising out of the sale of a capital asset, which is nothing but a capital gain. Similarly, let us learn about the capital loss with the scenario if the value of the asset decreases due to any of the bad rumors or because any of the economic fluctuation. Suppose if the value of the property has been decreased from rupees 10 lakh to rupees 7 lakh, and now you have decided to sell the property. As the value of the property is been decreased, you want to sell it off so that to avoid any of the future losses, and hence you got a buyer who is willing to buy the same property for rupees 7 lakh, and hence you sold this property with loss of rupees 3 lakh. Let us find the capital loss by using the formula for the same. Capital gain or loss is equal to purchase price minus selling price, that is rupees 10 lakh minus rupees 7 lakh is equal to rupees 3 lakh. Here you incur the loss as the selling price of the asset is lesser than the purchase price, so it is a capital loss. Depending on the tenure of an holding of an asset, the gains against such an investment can be broadly classified into two types. First is short-term capital gains. If an asset has been sold within 24 months from the date of acquisition, then the profit earned from such a sale can be termed as short-term capital gains. Whereas, in case of long-term capital gains, here the profit is earned by selling of an asset which has been held by an assessee for the period of more than 24 months, then it can be termed as long-term capital gain. Now we are going to learn the duration of different capital assets for which the capital gain arising out of it can be termed as either long-term capital gain or the short-term capital gain. However, the tenure varies and it purely depends upon the type of capital assets. In case of financial assets like shares, bonds, debentures and government securities, if it has been sold within the period of 12 months, then it can be termed as a short-term capital asset, whereas if it has been sold after the period of 12 months, then it can be termed as long-term capital asset. In case of depreciable assets like computers, software and machineries, etc., It will always be a short-term capital asset irrespective of number of months or the years the assessee have holded that particular capital asset. In case of assets in holding like unlisted shares, buildings, etc., if the asset has been sold within the period of 24 months from the date of acquisition, then it can be termed as short-term capital asset, whereas if the asset has been sold after the period of 24 months, then it can be termed as long-term capital asset. In case of other assets like plot, agricultural land in urban area, etc., if the asset has been sold within the period of 36 months from the date of acquisition, then it can be termed as short-term capital asset, whereas if the asset has been sold after the period of 36 months, then it can be termed as long-term capital asset. Now we are going to learn the different features between the short-term capital gain and the long-term capital gain. In case of short-term capital gain, tax is high as compared to long-term capital gain, whereas in case of long-term capital gains, tax is low. Next we have STT, that is short-term tax, which is applicable on short-term capital gain and which is not applicable on long-term capital gains. Next we have indexation, as the short-term capital asset is not being holded by an assessee for long period of time, and hence the time value of money is not being considered. Hence here the indexation benefit is not included, whereas in case of long-term capital gain, indexation benefit is being included. Next we have tax exemption. In case of short-term capital gain, tax cannot be exempted in any of the condition, whereas in case of long-term capital gain, tax can be exempted in many of the cases. Now we are going to learn about the assets which are excluded from the capital assets for the purpose of capital gains. First is stock in trade. Any shares or the stock in trade which are active in your portfolio, which you have not sold and you have not realized any of the gain out of it, is been excluded from the capital gains. Next is agricultural land in the rural area and any of the movable asset except jewelry and the gold deposit bond under the scheme gold deposit scheme 1999. What is indexation? Indexation is used to adjust the purchase price of an investment to reflect the effect of inflation on it. A higher purchase price means lesser profits, which effectively means a lower tax. With the help of indexation, you will be able to lower your long-term capital gains, which brings down your taxable income. Let us learn the concept of the indexation with the example of selling a property. If in case we are selling a house or a property which we have bought for rupees 10 lakh and now we are selling it for rupees 20 lakh. As we have already learned in our previous video that indexation is applicable only in case of long-term capital gains, let us learn this with the help of simple example. Now let us calculate the capital gains for the short-term capital asset without indexation. As we already know the formula, that is capital gain or loss is equal to selling price minus buying price, that is rupees 20 lakh minus rupees 10 lakh will fetch a gain of rupees 10 lakh, which will be a taxable income. Similarly, let us calculate the same for long-term capital asset with indexation. For similar example, that is rupees 20 lakh minus rupees 10 lakh, we are going to get the gain of rupees 10 lakh. Here, unlike the short-term capital asset where we are going to pay the tax on the entire sum of rupees 10 lakh, here it is not so, as it is a long-term capital asset we are going to get the indexation benefit. Here, instead of considering the buying price, we are going to consider the fair market value, that is rupees 15 lakh. Here selling price minus fair market value, that is rupees 20 lakh minus rupees 15 lakh, we are going to get rupees 5 lakh as our taxable income. Here in case of the long-term capital asset, the taxable income is much lesser when compared to the short-term capital asset. let us start with today's topic. First, we are going to learn the format for computation of short-term capital gain or short-term capital loss. In the format, first we have to consider sales proceeds. From the sales proceeds, we have to deduct cost of acquisition, cost of improvement and the selling expenses. When we deduct all these three items from the sales proceeds, we arrive at short-term capital gain or short-term capital loss. Next, let us learn the format for computation of long-term capital gain or long-term capital loss. Here, in case of long-term capital gain or loss, we have to consider the indexation benefit, which is applicable only in case of long-term capital asset. Here, we have to take sales proceeds, from which we have to deduct index cost of acquisition, index cost of improvement and the selling expenses. When we deduct all these three items from the sales proceeds, we arrive at long-term capital gain or long-term capital loss. Now, let us learn the formula for calculation of index cost of acquisition. That is, cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. Next, we have the formula for computation of index cost of improvement. That is, cost of improvement into CII value in the year of sale divided by CII value in the year of improvement made. Now, let us learn what are the CII values which we have used in the calculation of index cost of improvement and the index cost of acquisition. CII values is an index used to calculate the notional increase in the value of an asset due to inflation. Here, we have listed out different CII values for the respective years which we have to utilize in the calculation of capital gains. Now, you might wonder what we have to consider as the CII values for the assets which has been purchased before 2001 and 2. Here, we have the solution for the same. In such a case, we have to consider both the actual cost of acquisition and the FRV value as on 1st April 2001. By comparing both of this, we have to consider any of the value whichever is higher, and this value have to be used for calculation. And the CII value will always be 100 if the asset is been purchased before 1st April 2001. Now, let us know some of the important points to be remembered before making calculation for capital gains. If in case the assessee has owned the asset without incurring the cost of acquisition, like he may have got the asset in the form of gift or as ancestral property, in such a case, the cost of acquisition will be the cost incurred by the previous owner of the asset. And in case if the improvement is made for an asset before 1st April 2001 should be ignored, and only the improvement made after 1st April 2001 should be considered for indexing. And in case of advance, if the advance money is received and forfeited during the year 2013-14 and early to that previous year, such money should be subtracted from the cost of acquisition, whereas if any of the advance money received and forfeited after the year 2013-14, such amount has to be taxed under the income from other sources, and it will not be deducted from cost of acquisition. In case of depreciable assets like plant and machinery, it will always be a short-term capital asset. For this, we have to use this particular format for computation of short-term capital gain or loss, where we have to take the sales proceeds, from which we have to deduct the depreciation under written down value method, from which we arrive at short-term capital gain or loss. In case of debentures and bonds, indexation is not required as it is not affected by the inflationary changes. In case of self-generated assets like goodwill, patent, trademark, etc., there will be no cost of acquisition. Let us start with the problem number 1. Here, we are going to learn the computation of long-term or the short-term capital gains. Let us have a look on the problem number 1. Here, From the following information furnished by Mr. Vivek, we have to compute his income from capital gains for the assessment year 2020-21. Solution. First, we have to write the name of an assessee, status, assessment year and the previous year. As we know the format for computation of long-term or short-term capital gain or loss, first we have to take the sales proceeds, from which we have to deduct index cost of acquisition, index cost of improvement and the selling expenses. When we deduct all these three from the sales proceeds, we arrive at long-term capital gain or long-term capital loss. From the given problem, we can say that the house property is a long-term capital asset as it has been purchased on 1st December 2000. Let us proceed with solution. Step 1. Finding the sales proceeds or the stamp value from the given data. Here in the problem they have mentioned the stamp duty value as of 1920 is rupees 54 lakh. So we have to take it down. First we have to take it down, sales proceeds or the stamp value, and we have to write the amount in the outer column of the format. That the given house property is a long-term capital asset, so we have to consider the indexation benefit. Hence, let us calculate the index cost of acquisition and the index cost of improvement. As this particular property is been purchased before 1st April 2001, we have to follow this particular format for computation of index cost of acquisition. First, we have to take the actual cost of acquisition given in the problem, which amounts to rupees 2,50,000, and the FRV value as on 1st April 2001 amounts to rupees 3,50,000, and from both of this amount we have to take which amount is higher among these two, and this amount has to be considered for calculation of index cost of acquisition. Now let us calculate the index cost of acquisition for rupees 3,50,000, which was a FRV value. So the formula for calculation of index cost of acquisition is cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. So cost of acquisition, that is rupees 3,50,000 into CII value in the year of sale, that is in the year 2019-20, which is 289. So we have to take it down, and the CII value in the year of purchase, as the asset has been purchased before 1st April 2001, the CII value will always be 100. So when we calculate rupees 3,50,000 into 289 divided by 100, we will get the cost of acquisition of rupees 10,11,500. So we have to substitute the same amount in the format. Next, cost of improvement. As we know from our previous videos that any of the improvement made before 1st April 2001 has to be ignored, and only if it is done after 1st April 2001 then it has to be considered. In the given problem we have two additions. First is cost of addition or improvement in the year 2000, so we have to ignore it as it is before 1st April 2001. Next we have cost of addition made in the year 2004 and 5, which amounts to rupees 77,700. It has to be considered as it is been made after the year 2004. So the formula for calculation of index cost of improvement is cost of improvement into CII value in the year of sale divided by CII value in the year of improvement. The cost of improvement is rupees 77,700. The CII value in the year of sale, that is in the year 2019-20, it is 289, and the CII value in the year of improvement made, that is for the year 2004 and 5, is 113. So when we calculate it, that is rupees 77,700 into 289 divided by 113, we will get the cost of improvement of rupees 1,98,720, which we have to take it down in the format. we have to take the selling expenses from the given data in the problem. As in this problem, they have not mentioned anything about the selling expenses, so we have to take it as nil. And now we have to add both of these values, that is index cost of acquisition and the index cost of improvement. We will get a total of rupees 12,10,220, and when we deduct this amount from the sales proceeds or the stamp value, that is rupees 54 lakh minus rupees 12,10,220, we will get a long term capital gain of rupees 41,89,780. So when we deduct all those expenses, that is rupees 12,10,220 from the stamp value or the selling expenses of rupees 54 lakh, we will get a long term capital gain or the earnings of rupees 41,89,780. Let us move on to the problem number 2, where we are going to learn the computation of taxable capital gains for the different capital assets. From the given problem, we have to calculate the capital gains of Mr. Rajesh Naidu for the assessment year 2020-21 for his different capital assets, that is plot A, plot B and the jewelry, by using the following data. Let us calculate the capital gains of Mr. Rajesh Naidu for his plot A. As the date of purchase is 1st January 2008, we can say that the plot A is a long-term capital asset. So we can write it down as plot A long-term capital asset. Next we have to take the sales proceeds. As the sale price is given in the problem, that is rupees 22,30,000, which we have to take it down here. Then we have to deduct index cost of acquisition, index cost of improvement and the selling expenses. As we know the formula for index cost of acquisition, that is cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. As the cost of acquisition is given in the problem, that is rupees 2,40,000 into CII value in the year of sale, that is for the year 2020-21 the CII value is 289, which we have to take it down here, and divided by CII value in the year of purchase. As the asset is been purchased in the year 2007-8, the CII value will be 129. So when we calculate, that is rupees 2,40,000 into 289 divided by 129, we will get rupees 5,37,675. And next we have to take index cost of improvement. As for the plot A, there is no improvement made, so we have to kept it as nil. Next we have selling expenses. As the selling expenses is been given in the problem, which amounts to rupees 30,000, we have to take it down here, and we have to add both of these values, and we'll get a total of rupees 5,67,675. And finally we have to deduct this total from the sales proceeds, that is rupees 22,30,000 minus rupees 5,67,675. We will get a long-term capital gain of rupees 16,62,325. So from the plot A, Mr. Rajesh gets a long-term capital gain of rupees 16,62,325. Let us calculate the same for plot B. Here the date of purchase of plot B is 21st May 2013. So we can say that the plot B is also a long-term capital asset. So we can write it down as plot B long-term capital asset. As it is a long-term capital asset, we should make sure that the indexation benefit is been considered. Next we have to take the sales proceeds, which is given in the problem, which amounts to rupees 4 lakh, and we have to take it down in the format, that is sales proceed is equal to rupees 4 lakh. Then we have to deduct index cost of acquisition, index cost of improvement and the selling expenses. First we have to calculate the index cost of acquisition. So the formula is index cost of acquisition is equal to cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. First, the cost of acquisition is rupees 1 lakh, which we have to take it down here, and the CII value in the year of sale, that is in the year 2020-21 is 289, and in the year of purchase, that is for the year 2013-14, the CII value is 220. So we have to take it down and we have to calculate the index cost of acquisition, that is rupees 1 lakh into 289 divided by 220. We will get rupees 1,31,364. And next we have to calculate index cost of improvement. In the given data, we don't have any of the information related to the improvement for plot B, so we have to write it as nil. And next, there is no information related to selling expenses too, so we have to write it as nil. So we have to take the value, that is index cost of acquisition, and this value we have to deduct from sales proceeds, that is rupees 4 lakh minus rupees 1,31,364. We will get a long-term capital gain of rupees 2,68,636. As we know, the jewelry is also a capital asset, so we have to make the calculation for jewelry too. Here, the date of purchase of the jewelry is 1st April 1988. So we can say that the jewelry is also a long-term capital asset. Next, we have to take the sales proceeds, which is given in the problem, that is rupees 20,60,000, which we have to take it down in the format. Next, we have to deduct index cost of acquisition, index cost of improvement, and the selling expenses. And in case of index cost of acquisition, as the jewelry is been purchased before 1st April 2001, we have to take into the consideration the actual cost of acquisition and the FRV value, and we have to take whichever is higher. That is, the actual cost of acquisition is rupees 1 lakh and the FRV value as on 1st April 2001 is rupees 2,20,000. So whichever is higher, so rupees 2,20,000 is higher, so we have to take rupees 2,20,000 for calculation of index cost of acquisition. So as we know the formula, that is index cost of acquisition is equal to cost of acquisition into CII value in the year of sale, that is in the year 2020-21 the CII value is 289, so we have to take it down, divided by CII value in the year of purchase. As we know, if the asset has been purchased before 1st April 2001, then the CII value will always be 100. So the index cost of acquisition will be rupees 2,20,000 into 289 divided by 100. We will get rupees 6,35,800. Next, we have index cost of improvement. As no improvement can be done in case of jewelry and there is no any information provided in the problem, so we have to take it as nil. Next, we have a selling expenses. Here we have the selling expenses of rupees 60,000, which we have to take it down in the format. Now we have to total it down both of these values, that is index cost of acquisition and the selling expenses. We will get the total of rupees 6,95,800, and this value we have to deduct from the sales proceed, that is rupees 20,60,000 minus rupees 6,95,800. Here we will get a long-term capital gain of rupees 13,64,200. So finally, we have to calculate the total capital gains of Mr. Rajesh Naidu. First, we have to take it down all the long-term capital gains earned by Mr. Rajesh Naidu, that is from plot A, Mr. Rajesh got a long-term capital gain of rupees 16,62,325, and from the plot B he got a long-term capital gain of rupees 2,68,636, and from the jewelry he got a long-term capital gain of rupees 13,64,200. So when we total it up, all the long-term capital gains, we will get rupees 32,95,165, and Mr. Rajesh Naidu does not have any of the short-term capital assets, so he doesn't have any short-term capital gains, so it is nil. When we total all the gains, we will get a total of rupees 32,95,165, which is a total capital gain of Mr. Rajesh Naidu for the assessment year 2020-21. First, we are going to learn what is exemption in capital gains mean. A capital gain exemption is an exclusion from the rules that normally apply to realization of capital gains for tax purpose. Under normal circumstances, when a taxpayer realizes a capital gain, it is taxable as income and it must be reported on tax documentation. Now, we are going to learn the various exemptions in brief. That is, under section 54, 54B, 54D, 54AC, 54F and 54G. First, we are going to learn the exemption under section 54, that is, sale and purchase of residential house. Any long-term residential house held by an assessee is sold and the capital gains arising out of it can be claimed as exemption if the capital gain amount is been reinvested in purchase of new residential house either 1 year before the date of sale or within 2 years from the date of sale, or construct a new house within 3 years from the date of sale, or deposit the capital gains amount in the capital gain deposit account in the bank, provided the new house is been held by an assessee for the period of 3 years. If not, the exemption will be withdrawn. We have exemption under section 54B, that is, sale and purchase of agricultural land. Any agricultural land, either short term or the long term, is held by an assessee is sold and the capital gains arising out of it can be claimed as an exemption if the capital gain amount is been reinvested in purchase of new agricultural land either 1 year before the date of sale or within 2 years from the date of sale. Next, deposited the capital gains into capital gain deposit account in the bank, provided that the new agricultural land is held by the assessee for a minimum of 3 years. If not, the exemption will be withdrawn. Next, we have exemption under 54D, that is, compulsory acquisition of industrial undertaking by the government. When an assessee, as an industrial undertaking, holds any of the land and building or machinery which has been compulsorily acquired by the government, which is used for industrial purpose for at least 2 years, then the capital gains arising out of it can be claimed as an exemption if the gain is been reinvested in the purchase of new land and building for the purpose of industrial undertaking within 2 years from the date of acquisition, or deposit the capital gain into capital gains deposit account in the bank, provided that the new industrial undertaking is been held by an assessee for the minimum of 3 years. Next, we have exemption under section 54EC, that is, purchase of government bonds. Any long-term capital asset held by an assessee is sold and the capital gains arising out of it is been exempted if the gain is been reinvested in purchase of bonds such as NHA, that is, National Highway Authority. Next, Rural Electrification Corporation Limited banks or Indian Railways Finance Corporation bonds, or deposited into the capital gains deposit account, provided that these bonds are held by an assessee for the minimum of 3 years. If not, the exemption is been withdrawn. Next, we have an exemption under section 54F, that is, sale of any capital asset other than residential house but purchase of residential house. Any long-term capital asset held by an assessee is been sold, and the capital gains arising out of such gains can be claimed as an exemption if the capital gain amount is been reinvested in the purchase of new house either 1 year before the date of sale or within 2 years from the date of sale, or construction of a house within 3 years from the date of sale, or deposited into capital gains deposit account. Next, we have exemption under section 54G, that is shifting of industrial undertaking from urban area to rural area. When an industrial undertaking is situated in urban area is been sold and the capital gains arising out of it can be exempted from tax if the amount is been reinvested in establishing a new industrial undertaking in the rural area either 1 year before or within 3 years from the date of sale, or deposit the money in capital gains deposit scheme, provided that the new industrial undertaking is held by an assessee for the period of 3 months. If not, the exemption is been withdrawn. If the amount reinvested in the purchase of a new house is less than the capital gain, then the proportionate exemption has to be given by using the formula. The formula is capital gains into cost of a new house divided by net sales consideration minus selling expenses. Let us compute the capital gains for the assessment year of Mrs. Vimla using the following information. Let us proceed with house 1. The first and foremost step is to identify whether the given capital asset is a long-term capital asset or the short-term capital asset, because if the asset is been long-term capital asset, then we have to consider the indexation benefit. If not, we should not. The first, we have to identify whether the asset is a long-term or the short-term. It has been given in the problem that she got this house from her brother as a gift on 15/8/2001, and for which her brother has purchased this house in the year 1979. So it means the given asset is a long-term capital asset. So we have to consider the indexation benefit. Let us proceed further with the calculations. First, we have to take the sales proceeds or the stamp value. In the problem, they have given that she sold the house in the year 30/9/2018 for rupees 18,50,000. So it has been given in the problem that she is going to sell this particular house for rupees 18,50,000. So we have to take it down in the outer column. Next, less index cost of acquisition. As we know that the formula for calculation of index cost of acquisition is cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. As we know that Mrs. Vimla has not incurred the money in purchase of this house, as this house is been gifted by her brother. So as we know from a previous problem that any of the asset held by an assessee, which is where the assessee has not incurred any of the cost for acquiring that particular asset, then the cost of acquisition will be the amount incurred by the previous owner of the asset. Here the previous owner of the asset is her brother. So he had purchased this house in the year 1979 for rupees 65,000. So now we have to note that the asset is been purchased before 1st April 2001. So we have to compare whether the actual cost of acquisition or the FMV value, whichever is higher. Here the FMV value is been given as rupees 70,000. Here we have to compare whether the cost of acquisition, that is rupees 65,000, is higher or the FMV value rupees 70,000 is higher. So we know that FMV value is higher than the cost of acquisition. So we have to take rupees 70,000. Then the CII value in the year of sale. For the current year, the CII value is 289. We have to take it down. Then divided by CII value in the year of purchase. As the asset has been purchased before 1st April 2001, that is in the year 1979, it means for this particular asset the CII value will always be 100. So rupees 70,000 into 289 divided by 100, we will get rupees 2,02,300. Next we have to take index cost of improvement. The formula to calculate the index cost of improvement is cost of improvement into CII value in the year of sale divided by CII value in the year of improvement made. So we have to check it out whether Miss Vimla had done any renovation or any of the improvement to the particular house. Here it has been given that Vimla spent rupees 6,500 on its improvement on 10/9/2013. So take the amount rupees 6,500 into 289. We have taken amount 6,500 and the CII value for the current year is 289 divided by CII value in the year of improvement made. The improvement is been made in the year 10/9/2013. So the CII value for the year 2013-14 is 220. We have to take it down. So 6,500 into 289 divided by 220, we will get 8,538. Next we have to check for the selling expenses. In the given problem they have not mentioned anything about the selling expenses, so it is nil. Then add index cost of acquisition and the index cost of improvement and write it down in the outer column. And now deduct this total amount from the sales proceeds. We will get a long-term capital gain. As the amount is positive, it is a gain. So we got a long-term capital gain of rupees 16,39,162. Here we have to note that she is also purchasing a new house. Once she sold this house for rupees 18,50,000, she is going to purchase another house for her residence on 25/3/2019 for rupees 9 lakh. So recall the exemptions. Here the exemption is sale of a residential house and the purchase of a residential house, which is nothing but the exemption under 54. So we have to deduct the exemption under section 54, which states sale of a residential house and a purchase of a residential house. So less the deduction, as she has been purchasing a new house for rupees 9 lakh, take rupees 9 lakh as an exemption. So deduct rupees 9 lakh from the long-term capital gain. We arrive at net long-term capital gain of rupees 7,39,162. Now let us proceed further with house 2. As we know that first we have to identify whether the given asset is a long-term capital asset or the short-term capital asset. In the problem, it has been mentioned that the second house is been purchased in the year 78. So it is a very long period of time. So we can consider this house as a long-term capital asset. As it is a long-term capital asset, we have to consider the indexation benefit into consideration. Let us proceed with the calculation part. First, we have to take a sales proceeds or the stamp value. It is being given in the problem that she is going to sell this house for rupees 8,50,000. So we have to take it down. The stamp value, that is 8,50,000, which we have to take it down in the outer column. Next, deduct index cost of acquisition. So as we know the formula for calculation of index cost of acquisition, index cost of acquisition is equal to cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. Here, this asset is been acquired by Miss Vimla for rupees 56,000. So we have a cost of acquisition rupees 56,000 here. Next, we have to take it down the CII value in the year of sale. For the current year, we have to consider the CII value as 289 divided by CII value in the year of purchase. The asset has been purchased in the year 78. So the CII value for the year 78 is 129. When we calculate, that is rupees 56,000 into 289 divided by 129, we will get 1,25,458. Next, we have to take index cost of improvement. In the given problem, they have not mentioned anything related to the improvement or any of the renovation. So we have to take it as nil. Next, we have to take the selling expenses. In the problem, they have mentioned the selling expenses of rupees 47,800. So we have to take the selling expenses as 47,800. Now add both the amounts, that is index cost of acquisition and the selling expenses, and write it down in the outer column, that is rupees 1,73,258. When we deduct from the sales proceed, that is rupees 8,50,000 minus 1,73,258, we will get a long-term capital gain of rupees 6,76,742. Okay, here she have not purchased any of the another house by selling this particular asset, so there is no exemption given for this particular asset. The next capital asset is jewelry. As the first step is to consider whether the given capital asset is a long-term capital asset or the short-term. We have to know in which year it has been purchased. It has been purchased in the year 2007-8, so it is a long time when we compare it to the current year. So it is a long-term capital asset and we have to consider the indexation benefit. Let us proceed with the calculation part. First, we have to take the sales proceeds or the stamp value. Here they have given a sales proceed that she is going to sell this jewelry for rupees 8,50,000. So we have to take this rupees 8,50,000 in the outer column less index cost of acquisition. As we know the formula, that index cost of acquisition is equal to cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. The cost of acquisition, the amount for which she had purchased a jewelry, is rupees 75,000. So the cost of acquisition is rupees 75,000, which we have to take it down here, 75,000 into CII value in the year of sale. So for the current year, the CII value is 289 divided by CII value in the year of purchase. For the year 7-8, as it is purchased in the year 7-8, for the year 2007 and 8, the CII value is 129. We have to take it down. So when we calculate 75,000 into 289 divided by 129, we will get rupees 1,68,023. Here next is index cost of improvement. Here in the question they have not mentioned anything regarding the improvement, and so we have to take it as nil. Next we have to take the selling expenses. Here in the question there is neither any information regarding the selling expenses, so it is nil. When we take the index cost of acquisition in the outer column, and we have to deduct from the sales proceed. When we deduct rupees 8,50,000, when we deduct from the stamp value rupees 8,50,000, that is rupees 8,50,000 minus rupees 1,68,023, we will get a long term capital gain of rupees 6,81,977. Here as there is no exemption for a jewelry, so this amount is been taken as a final amount, that is long term capital gain. There is no exemption for the jewelry. Our next capital asset is a motor car. As we know from our previous videos that any of the movable asset except jewelry will not be considered as a capital asset, but here in the problem they have mentioned that the car is been used in the business, that is it is been used for the official purpose. So as the car is been used in the business, we have to consider it as a capital asset. Now we have to identify whether this particular asset is a short term or the long term. This asset is been purchased by Miss Vimla in January 2005. Even though it's a long period of time, this particular motor car has to be considered as a short-term capital asset because it is a depreciable asset. For any of the depreciable asset, irrespective of number of months or the years the assessee has hold that particular asset, it will always be a short-term capital asset. So as it is a depreciable asset, so the format changes. Here just we have to take the sales proceeds. From the sales proceeds we have to deduct the depreciation, that is written down value. So from in the given it has been given that the car is been sold on 1st 12 2018 for rupees 90,000. So the sales proceeds is rupees 90,000, which we have to take it down in the outer column. Next we have to deduct the depreciation, that is WDV, which will be given in the problem. Here it has been given the WDV as on 1st April 2018 is rupees 76,000. So the WDV or the depreciation given in the problem is 76,000. So we have to take it down as the WDV rupees 76,000. When we deduct rupees 90,000, when we deduct from rupees 90,000, that is sales proceeds minus written down value, that is 90,000 minus rupees 76,000, we will get a long term capital gain of rupees 14,000. Now we have a final step of this problem where we have to take the total of all the long term capital gains and the total of all the short term capital gains to know whether what is the amount of total long term capital gain and the short term capital gain did Miss Vimla gained. Now the first residential house was also a long term capital gain, so we have to take the amount rupees 7,39,162, and the residential 2, which was also a long term capital gain, we have to write the amount rupees 6,76,742, and the third capital asset jewelry was also a long term capital gain for her, so we have to write the amount rupees 6,81,977. So when we total it down all the long term capital gains, we'll get a total long term capital gain of rupees 20,97,881. Next we have to take the total of all the short-term capital gains. But Ms. Mimla has only one short-term capital asset, so we have to write only one short-term capital gain what she had. So that is from motor car. She gained rupees 14,000 as a short-term capital gain. So she don't have any of the other short-term capital gains. So we have to take this 14,000 itself as a total short-term capital gains. Let us proceed with the problem. Here we are going to learn computation of taxable capital gains with proportionate exemption. From the given problem, we have to calculate the taxable capital gains of Mr. Atmanan for the assessment year 2019-20. Here they have given the three different capital assets for which we have to compute the taxable capital gains, and here they have also asked whether Mr. Atmanan is eligible to claim exemption under section 54F, which states that sale of any of the other asset and the purchase of a residential house. Let us see in the solution whether Mr. Atmanan is eligible for the exemption or not. Let us proceed with the solution. First, we have to write the name Mr. Atmanan, status resident and ordinary resident, that is ROR, assessment year 2020-21 and the previous year 2019-20. The first capital asset is gold. Here, the gold is been acquired in the year 2008-9, so it is clear that the given capital asset is a long-term capital asset. So the indexation benefit has to be considered. First, we have to take the sales proceeds. In the given problem, they have given rupees 4 lakh as a sales proceeds, which we have to take it down, less index cost of acquisition. The index cost of acquisition given in the problem is rupees 60,000. As we know the formula, that is index cost of acquisition is equal to cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. The cost of acquisition is rupees 60,000 and the CII value in the year of sale, that is in the year 2019-20 is 289, and the CII value in the year of purchase, that is it has been acquired for this particular year, that is 2008-9, the CII value is 137. So when we calculate it, that is rupees 60,000 into 289 divided by 137, we will get rupees 1,26,569. Next, here there is no improvement made for the gold, so it is nil, and neither there is any of the selling expenses, so it is also nil. When we take the total, that is index cost of acquisition in the outer column, and when we deduct rupees 1,26,569 from rupees 4 lakh, we will get a long-term capital gain of rupees 2,73,431. Our next capital asset is securities. Here, the securities been acquired in the year 2013-14, as it is a long period of time, so it can be termed as a long-term capital asset. So the indexation benefit has to be considered. So first we have to take the sales proceed, that is rupees 1,50,000. Then we have to deduct index cost of acquisition. The formula is index cost of acquisition is equal to cost of acquisition into CII value in the year of sale divided by CII value in the year of purchase. Here the cost of acquisition given in the problem is rupees 40,000 and the CII value in the year of sale, that is in the year 1920 is 289, divided by CII value in the year of purchase. It is been purchased in the year 2013-14, for which the CII value is 220, so we have to take it down. So when we calculate it, rupees 40,000 into 289 divided by 220, we will get rupees 52,545. Next, we have index cost of improvement. Here the index cost of improvement is been not given in the problem, so it is nil. Here in the problem, neither there is any information regarding the selling expenses or the brokerage, so it is also nil. When we take rupees 52,545 545 in the outer column, and when we deduct, that is sale proceeds minus the amount, that is 52,545, that is rupees 1,50,000 minus rupees 52,545, we will get a long term capital gain of rupees 97,455. If the amount reinvested in the purchase of a new house is less than the capital gain, then the proportionate exemption has to be given by using the formula. The formula is capital gains into cost of a new house divided by net sales consideration minus selling expenses. We should remember the previous formula for the calculation of proportionate exemption if it is applicable for the problem. Here in the given problem, here they have asked whether Mr. Atmanan is eligible to claim exemption under section 54F, which states sale of any of the other asset and the purchase of a house property or the residential house. Here Mr. Atmanan, he have sold his plot and in return he had purchased a new residential house. So Mr. Atmanan is eligible to claim under section 54F. Let us proceed with the calculation part. First we have to take the sales proceeds, that is rupees 20 lakh in the outer column. Next we have to take, as the given plot is a long term capital asset which has been purchased in the year 2004-5, we have to take the indexation benefit. Index cost of acquisition is, the formula is index cost of acquisition is equal to cost of acquisition, that is rupees 1,40,000 into CIA value in the year of sale. It is been going to sell in the year 2019-20, for which the CIA value is 289 divided by CIA value in the year of purchase. The plot has been acquired in the year 2004-5, for which the CIA value is 113. When we calculate, that is rupees 1,40,000 into 289 divided by 113, we will get a index cost of acquisition rupees 3,58,053. Next we have index cost of improvement. Here in the given problem, there is no as such improvement. The improvement is not being given, so it is null. Next we have to take the selling expenses. Here they have given the brokerage paid on sale, that is 2%, which has to be always calculated on the sales proceeds. When we take 2% on rupees 20 lakh, we will get a selling expenses of rupees 40,000. Then when we add both of this amount, that is index cost of acquisition and the selling expenses, I will get a total of rupees 3,98,053. When we deduct this total amount from the sales proceeds, that is from rupees 20 lakh, we will get a long-term capital gain of rupees 16,01,947. As we know that Mr. Atmanan is eligible to claim exemption under section 54F, we have to deduct the exemption amount. So the house property, that is the new residential house, amounts to rupees 9 lakh. Here we have to note that the given the amount for which the house is been purchased, that is rupees 9 lakh, is less than the long term capital gain, that is rupees 16,01,947. Here the proportionate exemption has to be given, for which we have to use the formula, where first we have to take the capital gain amount, that is a long term capital gain amount, into cost of a new house. The new house is amounted to rupees 9 lakh, we have to take it down, divided by net sales consideration, which is nothing but the sales proceeds, minus selling expenses, which is nothing but 40,000. When we solve, we will get the amount rupees 7,35,588, which we have to write in the outer column of the exemption, and when we deduct these exemption amount from the long-term capital gain, we will get a net long-term capital gain of rupees 8,66,359. Now we have a final step of the problem. Mr. Atmanan does not have any of the short-term capital gain, so just we have to total up all the long-term capital gains of Mr. Atmanan. From gold, he gained a long-term capital gain of rupees 2,73,437. From securities, he gained rupees 97,455, and from the plot, he gained rupees 8,66,359. When we total it up, all the long-term capital gains, we will get a total capital gain of Mr. Atmanan, which amounts to rupees 12,37,245. This is the end of our series on capital gains and its taxation. So, Simplify India heartily thanks you people, all the subscribers, viewers and all the well-wishers for their patience and their immense support. And we would also like to have a feedback in our comment section. So friends, if you like our video and finds it informative, then please do share it with your friends, family and colleagues, and please do let us know the topics in the comment section on which you want us to come up in our further videos. Thanks for watching Simplify India. Please do support us by subscribing our channel. Simplify India.